Hey, it's Mike Lynch with AmeriFirst Financial, and it's time for your Monday morning mortgage update for the week of May the 10th. Hope everybody had a fantastic Mother's Day weekend. The weather was beautiful, a little windy, but we had a great weekend. We do an annual Mother's Day brunch. Of course, last year we didn't have it, and this year we resurrected it, and we had aunts, and we had grandmothers and mothers and a bunch of people at the house, and it was just a phenomenal weekend, just connecting with everybody for Mother's Day. I hope all the mothers out there had a great Mother's Day weekend. Okay, so what happened in the market last week and what can we expect this week? So actually last week, we expected rates to get worse last week, and they didn't. There was actually a slight improvement, very slight, but a slight improvement with rates. And one of the reasons we expected rates to get worse is because we expected a strong jobs report. We've been seeing a trend of increased jobs over the last few months, but actually the jobs report came in much weaker than expected. And there's a big reason for that. The government is paying people to stay home and not work. People are making more money not working than if they went and got a job, and this is in the lower income areas. It's a very sad commentary when private industry, private businesses are competing with unemployment for wages. For the economy to be healthy and to really move forward, this has to stop. People need to go back to work so that industries can make things so that we don't deal with the issues that are causing problems right now. So what are we looking at this week? Three things: inflation, debt, and retail sales. So let's talk about inflation. I sound like a broken record. We've been talking about this for quite some time. The Fed, we know, are keeping mortgage interest rates artificially low. And we know that mortgage interest rates are determined by the trading of mortgage-backed securities in the bond market. When money flows into that bond market and out of the stock market, and people want their money safe, that's going to affect mortgage rates, trading of mortgage-backed securities, and that's going to push rates low. Well, since the pandemic started, the Fed has been buying millions and millions, billions of dollars in mortgage-backed securities to keep mortgage rates artificially low. At some point, they're going to stop doing this. And the other thing is the federal prime rate is also low. All of this stimulates spending, stimulates home buying, stimulates businesses to invest in money because they can get low interest loans. And that means that people spend money and prices go up. The other thing that's causing this inflation is the consumer price index, which is expected, which is a key measure of inflation. And we expect that consumer price index, which is coming out Tuesday, to show inflation going up above 2%. Now, we expect inflation to increase into the mid to late summer and then maybe taper off a little bit once the honeymoon ends with all the stimulus money that's been pumped into the economy. We're seeing inflation in a lot of different areas: food, lumber, copper, gas, homes. We're not just seeing prices go up, but we're actually seeing inflation in different forms. One of the things is look at how much the cartons of stuff that you're buying food-wise and needed supplies, and how much you're paying for that. You're paying the same price, but you're getting less for what you're paying. It's starting to see a trend a lot of people are talking about. That's inflation. Your dollar is not going as far as it used to go. The other thing that's interesting is a report came out that rents are up 1% and wages are up 1%. Well, that's a wash. If your rent's going up 1% and you're making 1% more in wages, your dollar's not actually working for you. So again, we're just starting to see some of these little trends, numbers that are showing inflation is really going up. The second thing is debt. So we have been saying this for some time. We are in huge debt, massive debt, overwhelming debt in this country, and the debt needs to be paid at some point. Our kids, our grandkids, their grandkids, their grandkids are going to pay for this. We know taxes are probably going up. There's been proposals for that already. But how will we pay for the debt? You can either borrow your way out of debt or you can spend your way out of debt. Well, the most effective way is to spend your way out of debt, but the government is now choosing to borrow their way out of debt. And of course, they've been doing this for some time. So this week, there's 2 Treasury auctions. These happen on a regular basis. The Fed sells bonds so that people buy those bonds, and that's the way that they generate money. They're borrowing their way out of debt. And so because they have to pay that back at some point, they have to pay those bonds back at some point. And so we're really going to be watching this bond auction to see if there's an appetite for the 30-year. If there is, actually that's positive because more money's flowing into the bond market, which will maybe push those rates down a little bit. And then the third thing is retail sales. We expect a modest increase. How are people spending their money? This is a really key indicator of how they're spending the money. Are they buying stuff? Are they going to restaurants? Are they out buying products? Retail sales have increased recently, and that's been a good sign. However, much of the money that people received in stimulus, people are actually putting in the bank. They're not spending it at a rate that the Feds expected, economists expected. So will that trend continue? Will people save more money than actually spend? Saving more money is good, but they're saving money they're getting for free. That has a lot of impact. So if they spend the money, which is what the whole point behind the stimulus was meant to do, is spend money, pay your bills, then that is actually positive for the economy, and that could push rates down, or push rates up a little bit. So heavy economic week this week with a lot of volatility. We're cautiously floating starting out the week. There's more risk for rates going up than getting better and going down. So we'll be watching the market very closely, and we'll be ready to lock as soon as we see any changes. If you or your clients need any advice about mortgage rates or about what's happening in the economy that's going to affect mortgage rates, go ahead and give me a call. All my information is down below. If you know someone that could benefit from this video, please forward to them. I'd love to hear your input on what you think about my comments. Have a great, productive week, and we will talk to you soon. Bye-bye.